Gold and silver stocks are stocks. And in a market crash, the tertiary assets, the most marginal assets, decrease the most. And there is no asset in the world more marginal than a junior mining share. Stocks are stocks. I remember in the 1987 crash, gold and gold equities held up for precisely 24 hours. And then they followed the market lower. Even gold will be impacted, although gold will come back sooner. What happens in a crash is that the sell decision isn't made by the investor. It's made by the margin clerk. And the margin clerk doesn't care what you think about the relative value of your holdings are. They sell whatever has a bid to extinguish the debt to the house. Investors need to understand that in really precipitous declines, liquidity-related declines, there are no safe shelters. The investment categories that hold value recover the fastest. But in the immediate aftermath of a crash, there are no safe shelters, with the exception of cash.
In addition to highlighting the volatility of gold and silver stocks during market crashes, Rick Rule emphasizes the importance of holding cash as a strategic move. He suggests that while gold and silver may eventually rebound, cash remains a reliable shelter in times of uncertainty. Rule's analysis underscores the role of cash as a valuable asset for investors seeking stability amidst market turmoil. Furthermore, he delves into the manipulation of precious metal prices, pointing out the imbalance between futures and physical markets, and suggesting organized manipulation by major international banks.
Well, if they've been patient for the last 12 years, they've been rewarded. I look back and I began to materially increase my own holdings of gold in 1998, 2 years too quick. But if we go 2000 to 2024, we see a move in the gold price from $250 to $2,100. 8.6, 8.7% compounded a year for 24 years. I would ask investors who complain about that to give their head a shake. Gold has done precisely what I asked it to do. It's maintained my purchasing power. So when the gentleman says he's being patient, I need to say, really? What were your expectations? I'm not one of those who believes in any ongoing multi-decade manipulation. I believe that lower real and marginal gold and silver prices over 40 years had more to do with the strength of the U.S. dollar and the perception, at least, that savers were enjoying real interest yields on U.S. dollar denominated deposits than anything else. Why would you bother manipulating something that was going lower? Why would you try to suppress something that was falling of its own volition? I believe that the outlook changed in 2022 when what I believe was the real rate of inflation began to substantially exceed the yield available on U.S. dollar denominated instruments at the same time that the risk associated with those instruments increased. I note that in the period 1967 to 1972, the circumstance was the same and the market didn't care. But after 5 years, when the market did care, it cared in earnest. Now, as a follow-on with regards to manipulation, all markets are manipulated in the near term, gold being no exception. Markets as big as the LIBOR market and the U.S. Treasury market are manipulated in the very near term. And they are always manipulated in the direction that it is the easiest for the manipulators to manipulate. When gold markets begin to rise, it will be easier to manipulate those markets up, which occurred in my memory in the 1970s. For the last 40 years, the easy way to manipulate them is down. When you have a market where the futures market is so much larger than the physical market, the temptation to short-term manipulation is particularly intense. It is not uncommon for the silver futures markets to trade 200 times the volume of silver available for good delivery in a day. So a manipulator could establish a short ladder if he or she expected the silver price to be more likely to decline, a short ladder involving $1 billion or $1.5 billion in stages from 3 months out to 2 years, and then borrow a fair amount of physical which they dumped in the overnight market when the volumes were the least and where the damage they could do was the most, and then enjoy the change that they had affected in the spot market and its outsized impact in the futures market. And I think that happens probably on a quarterly basis. There's no other explanation for very large selling of gold and silver in the overnight markets when the volumes are the skinniest. A rational seller would be trying to maximize his or her yield on sale. In this particular instance, whoever the seller is trying to maximize their impact in the futures market. I would suggest that this is not the Trilateral Commission or the International Jewish Conspiracy or the Fed. I would suspect that these are organized cabals around the trading desks of major international banks, the same people who manipulated the Treasury market, the same people who manipulated the LIBOR market, the same people who manipulated the Eurodollar market.
Continuing his insightful analysis, Rick Rule delves into the risks associated with storing precious metals in vaults. He warns against entrusting gold and silver to marginal vaults, emphasizing the importance of selecting reputable institutions for storage. Rule advises investors to opt for vaults controlled by public companies with transparent financial records and regular external audits. Moreover, he highlights the government's potential to steal from citizens through taxation, regulation, inflation, and quantitative easing, rather than outright confiscation of bullion.
I think it depends on the vault. I think a bigger risk that people face in a bull market, a bigger risk than confiscation, is entrusting gold and silver to marginal vaults. If you're going to put money in a vault, make sure that the vault is controlled by a public company where you can see their balance sheet and their income statement. Make sure that the vault is subject to an outside audit every 90 days. It is so easy for the government to steal from you via taxation, via regulation, via inflation, via quantitative easing, that they have no need to steal your bullion. A tax increase or an excise tax or printing up $2 trillion out of thin air is a kind of theft which is absolutely legal and, by the way, is always applauded by the voters. Why would Congress subject themselves to the ire of a populace that has 400 million guns in private holdings when they could steal much more very easily in a way that's very popular with the voters? Too many people still believe that their government isn't a fraud. The sanctions that we had in place took place over a period of time when the American imports of Russian uranium doubled. And so we're trying to have sanctions where nobody, at least no voter, gets hurt. But the truth is that sanctions would be fruitless anyway. If we prohibited the import of Russian uranium, the Russians would sell it to the Chinese, and they'd sell it to the Indians. And then Australian and Canadian uranium that went to China and India would be diverted to the United States. This is all theater. Putin versus Biden is for the consumption of Russian and American voters. Nothing more. Now, it makes sense that with increasing demand for uranium, that there be increasing capacity around the re-enrichment and enrichment of uranium. There was a political consensus in the 1990s that blending down Russian and American weapons-grade uranium to fuel, which was a very good thing, by the way, would include an increase in Russian capacity for enrichment and re-enrichment, and the tacit agreement that the United States would rely on Russian capacity to do that. We've now learned that perhaps that wasn't such a wise idea, and it's likely that enrichment and re-enrichment capacity will be built outside of Russia. But assuming it isn't, what you would see is that fuel that the Russians couldn't sell in Western Europe and the United States would be diverted to emerging markets, and the fuel that they now consume from primary exports in Kazakhstan, Australia, and Canada would go to fulfill that demand, an enormous non-issue.
Today, we've delved into a wealth of insights with Rick Rule, covering the intricacies of market crashes, the manipulation of precious metal prices, and the risks associated with storing assets in vaults. Rule's analysis sheds light on the complexities of investment decisions and underscores the importance of understanding market dynamics. As we wrap up, I encourage you to reflect on the key points discussed and share your thoughts in the comments below.